Here we have the US dollar Canadian pair on the 4-hour time frame, and this was actually a trade setup that myself and my members took last year. So just to run through the process very quickly, price was moving downwards at the later part of 2017 and into February 2018 in a downward trend or intermediate downwards trend. Then simply using a downward sloping trend line on top of previous pivots, I then waited for price to break that trend line, and once it started also breaking previous market structure or levels of market structure, it signaled a potential change in trend. Now once the actual first and second level of previous market structure was taken out, I then moved to use my Fibonacci extension level. And in this case, I applied it over certain pivots on this upward or start of this upwards move. And magically, when price reached the first 100% Fibonacci extension level, we got a larger degree correction moving downwards again. At that stage, it was necessary to use my shift pitchfork, which is the one I mentioned before I use the most, especially when it comes to corrections. And once price reached the lower red warning line, the correction ended and price shot up much higher and continued the trend upwards. Now here is a close-up of that actual correction and how I applied my shift pitchfork and which anchor points I used on the correction. And basically I used where this high ended, the lower low back to the lower high, and it projected at an angle but much flatter than the standard pitchfork, median lines, lower median lines and lower warning lines to the downside, and it allowed me to identify before price reached an area or a zone where I thought this particular correction might end. And this is very important, guys. It gave me ample of time to get ready for a trade and to prepare and wait for my entry conditions before it actually happened. And now switching to a 5-minute chart, you'll see that once price moved within that price zone and touched the lower red warning line of my shift pitchfork, look what happened. There was momentum divergence on my MACD and a reversal candlestick formation pattern that I teach and follow. And this prompted myself and our members to enter into a position since all of the pieces of the puzzle has fallen into place. And this was our entry level, slightly above the reversal candlestick pattern with a predefined stop loss a certain distance below the pattern. Note that the stop loss was only 12 ticks below our entry level. And after we entered the trade, it was time to manage the open position, which is part of the last step of the EPS. Now, as you can see on the chart, I also use pitchfork to manage my open positions, but this time they are sloped into the direction I'm trading towards. What that allows you to do is know where you can be setting your targets and at the same time trail your stops a fair distance away from market without getting stopped out too soon. And in this particular trade, you'll see that this was our regional entry in the bottom down here with our regional stop loss of only 12 ticks, and the resulting move after entry catching the exact low of this correction lower resulted in a move of about 542 ticks, which equates to I think something like 47 to 1 risk-reward ratio, which was a fantastic trade overall, which we could manage for about over a month that took. And all the while price reached our first targets, we were able to trail our stop safely behind the market until our final target that was predefined before we even entered was reached, and we closed the trade down.